Jackie Barkow. Dr. Barkow is one of our professors here at IU Northwest, and she is one of our accounting professors. Fantastic resource for businesses in the area. She's very excited about being able to share her expertise, not only with her students, but our local business community as well. So with that, I'm going to turn things over to Jackie and let her begin telling you about, again, the wonderful world of taxes, because we all love taxes, right?
Well, thank you. Let me go ahead and share my screen here. Okay, so again, I'm going to kind of just give you an idea, introduce some taxes for small business, a little bit about myself. She already introduced a little bit about me, but I have been teaching accounting in higher education for a little bit more than 13 years. I've been with IU for right around 2 years now. My tax background, I worked 5 years in I did 5 years of tax preparation as a volunteer with VITA, which I love the VITA program, working with low to moderate income individuals in the area. And then I have 4 years of tax on my own, in my own consulting and tax preparation business. My tax background in my tax area is generally individual taxation and small business, generally Schedule C, individual business owners. I have my doctorate in business administration with a specialization in accounting, and my doctoral study was focused on training volunteer income tax preparers to help volunteers be able to navigate tax preparation with the individuals who qualified for VITA. I am an enrolled agent, which is an IRS recognized credential. It was required to pass 3 exams to become credentialed, and I sit on the board as vice president for the board of directors for the Indiana Society of Enrolled Agents. So what I'm going to go through today is kind of give very brief reminders about 2021, because your 2021 taxes are not, the deadline is coming up, but it's not quite here. I'm just going to go over the basic business entity types. If you're a small business or getting ready to start your business, just some ideas to think of businesses there are, and maybe some different tax perspectives there. And then I'm really going to go through Schedule C, which is for individual small businesses, items for your individual tax return, things that you should be keeping track of to maybe help next year's tax season maybe go a little smoother if it didn't this year, or just help make your tax preparer happy, things that you can do throughout the year to make the process smooth. And then I'm just going to briefly touch on some other types of taxes that go along with having a small business. Right, reminders for 2021 taxes. The deadline is approaching, so if you've not filed yet, hopefully you're close. If you have not started yet, you should probably get on that. Tax season, the tax filing deadline is April 18th. If you need to file an extension, just as a reminder, filing an extension does give you 6 months to file your tax return, but it does not give 6 months to pay the tax due. So if you're going to have a tax due, filing an extension does not extend that. You'll still have to make a payment based on where you're estimated to be. First quarter estimated payments for 2022 are also due April 18th of the year. So not only do you want to be ready by filing 2021 if you haven't already, but that first quarterly payment, if you have to make quarterly payments, is also due on April 18th, which is next Monday. All right, so just going over some different business types. A sole proprietorship is really the easiest type. You don't necessarily have to register with the state to start a business. I generally recommend you do, but you can just go start a business, right? So it is the easiest type. If you register with the state, you would only list one member, and then you would become a single member LLC. Okay, the owner is accepting all of the risks. but you are considered a disregarded entity for income tax purposes. So any income and losses passes straight through to the owner and the individual's income tax return. You are considered a separate entity for employment taxes, which we will get to in a little bit here. A qualified joint venture is possible between a married couple, and they can be considered a disregarded entity if they choose to be treated so. Partnerships are general or limited, a little bit more complex. In my opinion, it's the most complex type of tax return in terms of having a partnership. It is considered a separate legal entity from owners, but partners are liable for any partnership obligations. There would have to be some sort of partnership agreement. So something in place that says how income or losses or liabilities are distributed to owners. So a partnership would be required to file that tax return, and the income distribution is then passed to the partners on a Schedule K1. Again, the tax transactions can be complex for a partnership. The deadline for filing a 1065, which is a partnership tax return, is 15th day of the third month after their tax year end, which is generally March 15th. Okay, and that is also the deadline for distributing K1s to your partners. Okay. We also have C corporations. Corporations have limited liability. They're considered a completely separate legal entity. The issue with being a C corporation is you are subject to double taxation. The corporation is taxed as well as the individuals being taxed as recipients of dividends or any other payouts. Okay. Corporations are a little bit more difficult to form, and it varies by state to state, but you would file with the state and you would have shareholders as owners of the entity. The tax filing deadline for filing a 1120, which is the corporation tax return, is the 4th month after the end of the company's year, which if you're using a calendar year would then be April 15th. And then an S Corp is a little bit of a hybrid form of corporation. And I know Jana said she has an S Corp, so she could speak a little bit to it, but the income is still passed through to the shareholders. It does avoid some of that double taxation. There are some restrictions on being an S Corp. You can't have more than 100 shareholders. The shareholders have to be individuals. They usually can't be, I don't think they can be trust, they can't be foreign. But again, it does avoid some of that double tax. And the tax deadline for filing the 1120S, which is an S Corp tax return, and providing the Schedule K1 documents is March 15th. If you're looking for help determining what business type or what business structure is best for you, the website INBiz, it's INBIZ.in.gov, is a really good resource. They kind of give you a bullet point. Here's the different entity types. And I know when you set up your business, if you're not sure, they'll kind of walk you through some of the different entity types and what each one means.
Jacqueline,
Yeah.
could you just repeat that website and I'll send it out to everyone?
Sure. It's INBIZ.in.gov.
Thank you.
You're welcome. So again, this webinar is I'm focused on individual small businesses. So I'm going to focus on sole proprietorships. This would be an individual who's opened a business. If you articles with the state, you would be considered a single member LLC or an SMLLC. Okay. The Schedule C is used to determine your profit or loss from your business, and this amount carries forward to the 1040 of your individual tax return. So there weren't a whole lot of tax law updates at this point. Nothing significant is changing for next year at this point. So, but if you wanted to keep track, the IRS website, irs.gov, small biz is a good place to look. The IRS is pretty good about updating as changes are made. And then if you needed any additional information about filing the Schedule C, the instructions are pretty good. They do walk you through it. The IRS also has a publication for just about everything. So even within those instructions, there's links to a lot of other publications with additional information. And that might be really important if you're looking for help with figuring out how to depreciate your assets or use your home office or the home office deduction. So all of those are in here, but there are a lot of different publications. Or for you, if you're just trying to get everything ready for your tax professional, is making sure that you have an understanding of what should go onto your tax return or onto your Schedule C, so that as you're keeping track of your expenses for the year, you have an idea of where to categorize them, just to help make that process smoother. Okay, so Schedule C income. Generally with the income, not generally, income is either going to be by cash, or you might take credit cards, you might take checks. And if you are paid more than $600 from somebody, then you'll probably receive a 1099 NEC. So if you go do contract work for another business or for an individual, you might receive a 1099-C, or you should, if you are paid more than $600 for your services. And likewise, if you pay somebody more than $600 for services, you should be giving them a 1099 NEC at the end of the year. The deadline for mailing out 1099 NECs is January 31st. So, and if you have to submit 1099 NECs to anybody that you paid more than $600 to, so you paid somebody to put together a website for you, or you had some help getting something set up, you would have to submit that 1099 NEC to them, have it in the mail by January 31st. And then you're also required to then submit all copies of that 1099 plus, or all of the 1099 NECs plus a 1096. So that 1096 goes to the IRS with all of the copies of the 1099 NECs. And that just indicates who you paid and how much it was for. Okay, so anybody that you're receiving 1099s from will be submitting those. And it's just important that you kind of keep it separate. We'll see. It used to just say broken out by where did that income come from. So you'll want to keep track of all of your 1099 NECs. And then you should, if you haven't this year or in prior years, you most likely will next year if you use Zelle or Venmo, or I think it's Square, or any type of third party to collect payments on your behalf. So a 1099-K is from payment card transactions or third party transactions. So it's where you're accepting a bank card or a credit card or PayPal. They will send you a 1099-K to show you how much they've collected on your behalf. So it's helpful if you're using any sort of payment transactions to have a separate business account, have a separate business name, kind of keep it all separate. Just makes kind of separating your business from your individual transactions a little easier. If you're ever chosen for audit by the IRS, having everything organized just makes it easier, but also less likely that they'll question anything. They did change the 1099-K laws recently. And so in the next year, more people will receive 1099-Ks. And that's the same as the 1099 NEC in terms of the $600 minimum. So if you used a third party for collecting payments and it was more than $600, you'll receive that 1099-K, or you should. The last one, the 1099 miscellaneous, the NEC was meant to replace that miscellaneous. I'm still seeing a few here and there, but most of the miscellaneous 1099s that I see now are for other purposes, not part of a business income. I can't stress it enough, have a method for keeping track of all of your income. Not all of your income is going to go through or something like that. You're going to maybe collect cash and checks. So just have a good method for keeping track of that. It's great to just deposit it into a bank, but if you even keep just an Excel file or something, you would want to keep track of your income just so you can see how you're doing for the year. But come tax time, which is really what I'm focused on right now, it just makes it easier to kind of see, here's the income I had. Here's, if it came from this individual, I have this matching 1099 NEC. If it all came from PayPal, I have this matching 1099K. So it is important to just keep track. And then again, your tax professional will be very appreciative if you have it all organized. That doesn't mean they wouldn't ask for any types of receipts or additional documentation if you're keeping a well-organized summary. But you've got everything there, and it should be easy then to just go back and find. Okay, so some ordinary and necessary expenses. To be considered deductible, expenses should be considered ordinary or necessary. They shouldn't be extravagant. You shouldn't be going for example, for meals. I'm skipping ahead a little bit, but a lot of times they may question a meal if it's a little over the top, right? So it's considered ordinary and necessary. Rent, utilities, insurance costs, basic necessities for running a business. One thing about the phone is if you're running your business out of your house and you only have one landline, you can't deduct that first landline, but if you were to get a second one specific to the business, you can deduct that. Cell phones are a little tricky because most of us have a cell phone now and not a landline. And I would generally deduct a cell phone expense because you can't conduct your business without some way of them getting you, but it is different than a landline. Generally, so you have to select for your income and your expenses, your method, either your cash basis or accrual basis. You want to be consistent. The IRS loves consistency. So being consistent from year to year, you don't want to switch back and forth. You actually have to request permission to switch from one method to the other. But as your business grows, it's in the millions. I think you may have to switch to accrual basis if you end up being significantly larger than when you first started out. But for the most part, small businesses would use a cash basis. So once you pay it, that's when it becomes an expense. Typically for things like rent and insurance, if you pay for a whole year, you can take the whole year as an expense. Prepaid expenses, if they go beyond 1 year, then you can't take the full expense. Even if you've paid for it, you might have to save some of it for the following year. Meals are tricky because we all have to eat. So it has to have a documented business purpose. So if you're in your office for the day and you go out to lunch, you were going to eat lunch regardless. If you worked for somebody, an employer, and you went out to lunch, you'd be responsible for paying for that. And so the IRS disallows that. So you have to have a documented business purpose. Maybe you're taking a client out to lunch. And right now, 100% of the meal cost, if it's provided by a restaurant, is deductible, and it's 50% for other meals. And it seems kind of vague. Other meals, think of if you go buy a prepackaged sandwich from the grocery store for your employees, that would be the 50%. Whereas if you had food catered in for a luncheon or something, that would be provided by a restaurant. And entertainment expenses are not deductible. This was, I want to say, it was part of the Tax Cuts and Jobs Act. So back in 2017, entertainment expenses became non-deductible, and it was a big hit for a lot of businesses, maybe where their salespeople were taking individuals out to baseball games or operas or things like that. Entertainment is no longer deductible. Okay, some other non-deductible expenses. I just said entertainment. Fines and penalties are not deductible. Political contributions or any type of lobbying costs. education to meet minimum requirements for a business. So I'm just going to pick on a hair salon or a hairstylist for a minute. The education cost to get that license wouldn't be deductible, but then every year if they do additional training or go through additional continuing education, those costs would be. So to meet the minimum requirements, you can't deduct, but any additional costs for keeping up with the profession, you can. And then income taxes aren't deductible, but I will talk at the end of the Schedule C discussion about making sure keep track of your estimated payments. They're just not deductible from a Schedule C. Okay, in terms of mileage, so driving to and from home to your place of business doesn't count towards mileage, but driving for any other business purpose should count, right? So if you leave your office and you go to, or you leave your home and you go to a customer site, that first spot doesn't count, but then you go from anywhere else, it does, okay? The mileage rate for 2022 is 58.5 cents per mile. It was 56 cents, so it's going up 2.5 cents from 2021 to 2022. Something to keep in mind, the IRS, just like any of the other expenses, if you can't document them, they will disallow them. They're very picky about mileage. If you were ever asked to provide documentation of your mileage, you need to have good records. This is especially important if you're using your personal vehicle for both business and personal use. You need to keep track of, here are all of my miles for the year, and here are how many of them are business. And there are some really good apps, mileage tracker apps. Some of the common ones I've seen are Stride, Mile IQ, TripLog. Okay, so just be consistent in using it. And I know it's a pain every time you get in your car having to log something, but being able to keep track of those miles and then taking the deduction is way better than not having good records or any records and not being able to take a 58.5 cent per mile deduction when filing your tax return. Actual costs can be used in place of standard costs, but use caution if you're using the vehicle for other than business purposes, right? So if it's your primary personal vehicle, that you only get to deduct the actual costs that are the portion used. So if you drive 5,000 miles for business use and 15,000 miles for personal use, you only get to take 25% of each of those actual costs because that's the business use percentage. So, and make sure you keep good records, keep all those receipts, keep it organized in a way that you'll be able to find it. And then know that you want to take the one that's best, and you typically want to be consistent from year to year. If the vehicle is used exclusively for business, you have a separate vehicle for personal use, it's easier to use the actual cost because it's 100% business use. Yeah. Depreciation is deducted for your long-term capital assets used in your business. Okay. Bonus 100%, but this is set to expire at the end of 2022. All right, so bonus depreciation, it was 50% for a long time. It kind of went up, and then I want to say the last 4 years, it's been at 100%. Now you don't have to take it, and it's only for business or assets that are put into service in that year. So if you've been depreciating certain assets for the last 5-10 years, you can't just switch and say, I want to take 100% bonus depreciation this year. It's for assets placed in service this year. It's also the Section 179 deduction. It allows for increased depreciation. You can generally select how much Section 179 you choose. And it does have a cap. I want to say, I can't remember how much. It's somewhere in the million. I think it might be right at $1 million is the maximum Section 179 that you can take in a year. Assets that are not used 100% for business purposes, or other assets that you decide not to take 100% bonus depreciation or Section 179, you'd use the maker's rates. So things to keep in mind, you need to know the amount that you paid for it, and the date that it was placed in service. Okay. And then a note there at the bottom to be aware that Indiana does not recognize the bonus depreciation, and Indiana does not recognize more than 25,000 taken for section 179. So if you choose to take a bonus depreciation expense for this year for your federal return, the amount that you expensed less the amount that you could have expensed if you were using the makers tables has to be added back to your Indiana income return, your income on your Indiana tax return. Home office deduction. This is another one. The area has to be used exclusively and regularly for trade or business. So if you set up your computer at your coffee table in the living room, that's not a home office unless you don't let anybody else in the living room to use that space. So you must have an area specifically designated, separately identifiable from other living space. Exclusions include if you're using the area for storage or if you're running a daycare. So daycare has a specific, a separate calculation that they use, and they base it on the number of hours that you offered the daycare services. Again, they don't want you to limit childcare into a small space so you can take a home office deduction, but they also don't want to not allow you to have a home office deduction if you're using your home to run a business, such as a daycare. You can use the simplified method or your actual expenses. So under the simplified method, it's $5 per square foot, and the square foot not exceed 300 square feet. So if you have a specific office, like right now I'm in my office, I can take the square footage of the room, multiply it by 5. If the square footage exceeds 300, that's my maximum. Okay. If you choose to use actual expenses, you have to include both indirect and direct costs. So direct costs, if you carpet the room, you paint the room, those are specifically specific costs for that. Indirect costs would be, well, if you're in a square foot room out of a 1,000 square foot house, you're looking at 20%, right? So you get 20% of the utilities, insurance, anything like that. Those are all indirect costs. And again, it's what goes towards the whole household, and you only take the percentage that's applicable to your space. All right, let's talk about records. Okay, so our objective here is, again, to talk about taxes. And so we're at the end of our 2021 tax season. Hopefully you're trying to think about 2022 taxes and what you can do to make it easier and better next year. Take advantage of anything that you're entitled to deduct. So to make tax times easier, just make sure that you devise a consistent method for keeping track of all of your income and expenses. So it's easy to misplace or lose or set aside things and say, I'll get to that later, I'll get to that later. And then before you know it, it's the end of March, you still haven't reached out, you still haven't put everything together. And it's easier to keep track of throughout the year if you put together some sort of consistent method. Okay, keep receipts and any documents available and organized. Your tax professional may not ask for all of those receipts, but you should be able to provide them if ever asked for them. Okay. If you use a computer system such as QuickBooks, that does help. It helps organize, it's helpful to run reports, provide that access to your tax professional. And you can even use Excel if you're small enough. So if you don't have a lot of expenses, you don't have a lot of income, you're still relatively small, just setting up a good Excel file is a good summary to keep track of everything and help you organize. But just know that you'll have to have a plan B if you become too big, because Excel is great, but if you are a growing business, you may eventually want to switch over to something like QuickBooks or a different accounting software. Something that's not on here, but super important, and I did mention, and things to remember, estimated payments. So if you are a small business and that's your only source of income, you want to be making those estimated payments throughout the year. Nobody likes to get a huge tax bill at the end of the year, especially nobody likes to get that if they weren't expecting it, right? So as an individual, from a tax perspective, if you have a small business, you are also responsible for the Social Security and Medicare taxes as both the employee and the employer. If you worked for a company, the employer would pay their half of the Social Security and Medicare, but you're responsible for both. So not only are you paying the income taxes, you're also paying the Social Security and Medicare taxes. You do pick them up on your tax return. So when you're filling out your Schedule C and your 1040 for your individual tax return, but it does make your tax a little bit higher. So you want to make sure that you work with a tax professional to figure out any federal and state estimated payments you should be making. Generally, you will avoid paying any underpayment, penalties, and interest if you paid 90% of this year's tax or 100% of last year's tax. And that's actually 110% if your income is over $150,000. You also won't pay any penalties and interest if you owe less than $1,000. But it is important that you work with a tax professional to say, here's how much I expect to make this year. And I have had clients reach out and say, this year's going way better than I thought, let's update these. And so halfway through the year, we'll change those estimated payments to make sure that we're meeting or not getting any surprises and paying as is earned. The way that you're making payments is a pay-as-you-go system. So you should be making quarterly payments, again, unless you won't hit any penalties or you're not required to make those estimated payments. And you'd want to make payments both for federal and for state. So just a few things about other taxes. Other taxes to be aware of as a small business. There are other things to be maybe that could be specific to your specific industry, but some things I wanted to make you aware of that I've had clients maybe come to me and they're like, what are you talking about? And so I just want to make sure that you're aware of them and you know that they're there. Property taxes, and that's personal property taxes, not property on your building, but property on your business assets. Sales taxes, if you're providing sale, or if you're selling items, your retail of any kind. And then employer taxes, if you are looking to hire employees or you already have, the different taxes that you should be paying or hopefully are paying if you already have. Let's talk about property taxes. Property taxes are actually, the property tax return is actually filed with your county. The good news, if you're not filing them already, it's for personal property. So this is for your business assets. Personal property is your business assets, things that you're using for business or items that are part of your business use. If you're a small business and you have personal property assets that are less than $80,000, you don't actually have to pay any tax, but you still have to file the return. And I know it's not much, but if you do not file the return, you may be assessed a $25 fine if you don't file it or if you file it late. There's the Form 102, 103, short or long, and then Form 104. And Form 104 is the form that is actually required every year. And then whether you use 102 or 103, short or long, really depends on what type of assets you have. Generally, if you are exempt from paying any tax, any personal property tax, you would use a 103 short filed with your Form 104. You can do them online. This website, in.gov/DLGF, is a really good site. You can go online and you can file it there. You can also subscribe to updates. So they've had different webinars that you can attend. They send emails, and it's PPOP, it's personal property online something, I don't know, but so they send out a lot of good updates. So they're worth signing up for if you're interested in that. And the deadline is May 15th. This year it's May 16th because, or for 2021, I think May 15th is on a Sunday. Okay, so sales taxes. If you are selling goods or property in Indiana, you should be collecting 7% in sales tax. You would want to register with the state to hold a registered retail merchant certificate. To pay those sales taxes, you can set up an Indiana an in-time account a year and a half. If you haven't checked, updated or used Indiana Access or Access Indiana, I can't remember what it is. It's their in-time account. Their online portal is super easy to use once you have an account. It's easy to go on and pay your sales tax, your employee taxes or employer taxes, your individual income taxes, make estimated payments. So they've really kind of streamlined it and made it a lot easier to use. The Indiana Biz website, I think we might have already put this at imbiz.gov or imbiz.in.gov, is also a good place to kind of get started. The Indiana Secretary of State website is good to use as well. That's separate from sales tax, or not necessarily part of sales tax, but it's a good site to use. Employer taxes. So for employer taxes, if you have employees, you should have withholdings for those employees. Their federal, state income taxes. If you're on Lake County, the Lake County tax rate is pretty high. Holding and making those estimated payments, or making those not estimated payments, those payments of your withholdings, your Social Security and Medicare on behalf of the employees. Your payroll taxes, so your portion is the employer of Social Security and Medicare, and then your state and federal unemployment taxes. So you'd use the 941 for your quarterly taxes, 940 for your federal unemployment, and then you can pay your state unemployment using the uplink, or get set up if you're not already set up using uplink.in.gov. And once you're in, using those systems are usually pretty easy. It's just making sure that you don't put it off or don't avoid making those payments. Something that I wanted to kind of discuss too is using, or not distinguishing between a contract worker and an employee is important. So a contract worker isn't an employee and you would just be paying them cash and they're responsible for paying the Social Security and Medicare. If you don't have any control over maybe the hours they work, you're not providing their tools or their equipment. But if you say you have to come in from 8 to 4, you're very specific about the job that they are paying, or that you are paying them for, then they would be an employee and you're responsible for the employer taxes.